For many, the world of investing feels like an exclusive club, reserved only for those with significant wealth. The idea of starting with little money might seem contradictory, a notion that stops countless individuals from even beginning. But in 2026, this perception couldn't be further from the truth. The financial landscape has evolved, making investing more accessible than ever before, regardless of your starting capital. So, why should you even consider investing, especially now in 2026? The reasons are as diverse as the people asking. Are you dreaming of a comfortable retirement? Hoping to save for your children's college education? Or perhaps you're working towards a down payment for your first home? Getting clear on your personal why is the crucial first step. It transforms abstract numbers into tangible goals, fueling your motivation. Once you have your why, it's time to understand the how. The magic behind long-term wealth building, especially with little money, is called compounding interest. Imagine a snowball rolling down a hill. It picks up more snow as it goes, growing larger and faster. Compounding interest works similarly. Your initial investment earns returns, and then those returns themselves start earning returns. Your money literally begins to make more money. The most effective way to harness compounding interest is to start early. The research consistently shows that the best time to start investing was yesterday, and the second best time is today. Even starting with a tiny amount gives your money more time to grow exponentially. This is why 2026 is an opportune moment. The longer your money is invested, the greater the impact of compounding. Beyond just the principle of compounding, 2026 itself presents a unique environment for investors. Experts suggest that with fading inflation and softening labor markets, combined with the exciting potential of AI-driven dispersion, this year favors investors over gamblers. This means a more stable, opportunity-rich market for thoughtful, long-term strategies, even when starting with small amounts. Before you put any money into the stock market, there's a critical foundational step: building an emergency fund. This is a separate pool of money, typically 3 to 6 months' worth of living expenses, kept in an easily accessible, liquid account like a high-yield savings account. It acts as a financial safety net, ensuring that unexpected events don't force you to sell your investments prematurely. With your emergency fund in place, the next practical step is to create a budget. This isn't about restriction, it's about gaining clarity and control over your money. By understanding exactly where your income goes, you can identify how much you can comfortably set aside for investing. Even small, consistent amounts can make a huge difference over time, so find a realistic figure you can commit to. Let's get specific about little money. The good news is, you can truly start investing with surprisingly small amounts. Some platforms allow you to begin with as little as $1. Others suggest starting with $25 a week, or perhaps $50, $100, or $500. The key isn't the initial lump sum, but the consistency of your contributions. Pick an amount that feels realistic and sustainable for you. For those with a workplace retirement plan like a 401(k), your absolute first investment priority should be to contribute enough to capture the full employer match. Think of this as free money. A 401(k) is a retirement savings plan sponsored by an employer, allowing employees to save and invest for retirement on a tax-deferred basis. Missing out on your match is like turning down a guaranteed return on your investment. Another excellent tax-advantaged account to consider is an individual retirement account, or IRA. Unlike a 401(k), an IRA isn't tied to your employer. It's a personal retirement savings plan where you can contribute pre-tax or after-tax dollars, depending on the type of IRA, and your investments grow tax-deferred or tax-free. IRAs offer flexibility and are a great option for almost anyone looking to save for retirement. When you're starting with small amounts, the approach to what to invest in doesn't need to be complicated. Forget trying to pick the next hot stock or spending hours analyzing company reports. For beginners, simplicity is your superpower. The goal is broad market exposure and diversification without needing a huge capital outlay. One of the best options for beginners, especially with little money, is a broad market index fund. An index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a market index, such as the S&P 500. Instead of buying individual stocks, you're buying a tiny piece of hundreds or thousands of companies, instantly diversifying your investment. Closely related to index funds are exchange-traded funds, or ETFs. An ETF is a collection of hundreds or thousands of stocks or bonds that trade on an exchange, just like a single stock. They offer instant diversification, low fees, and can be bought and sold throughout the day. Many index funds are structured as ETFs, making them highly accessible for beginners, even with small, weekly contributions. But what if a single share of an index fund or ETF is still too expensive for your budget? That's where fractional shares come in. Fractional shares allow you to buy just a portion of a single share of stock or ETF, rather than the whole thing. So, if a share costs $500, you could invest just $50 and own 1/10 of that share. This innovation truly empowers investors to start with as little as $1. For those seeking an even more hands-off approach, robo-advisors are an excellent choice in 2026. A robo-advisor is a digital platform that provides automated, algorithm-driven financial planning services with little to no human supervision. They build and manage a diversified portfolio for you based on your risk tolerance and goals, usually for very low fees and with low minimum investment requirements. Ready to dive in? The practical step is to open an online brokerage account. Look for platforms that align with your goals and skill level. Many popular brokerages offer user-friendly interfaces, low or zero trading fees for stocks and ETFs, and support for fractional shares. Do your research to find one that fits your comfort level and investment strategy. One of the most powerful habits you can adopt, especially when starting small, is to automate your investments. Set up automatic transfers from your bank account to your investment account on a regular schedule, perhaps weekly, bi-weekly, or monthly. This removes the need for willpower, ensures consistency, and allows you to benefit from dollar-cost averaging, buying more shares when prices are low and fewer when they are high. Remember, the goal isn't to start with a huge sum, it's to start and be consistent. Whether you're investing $25 a week or $100 a month, regular contributions are far more impactful than waiting for a large lump sum that may never materialize. This disciplined approach builds wealth steadily over time, leveraging the power of compounding with your regular additions. Investing, particularly with small amounts, is a long game. Don't expect to get rich overnight. There will be market fluctuations, and some days your portfolio might be down. The key is to stay patient, stick to your strategy, and avoid making impulsive decisions based on short-term market noise. Focus on your long-term goals and let time and compounding do their work. While investing with little money is accessible, it's not without its potential pitfalls. Avoid trying to time the market, or trying to predict when stocks will go up or down. Also, resist the urge to put money into the market that you might need in the short term. Remember your emergency fund. Finally, don't let market drops affect your essentials by investing money you can't afford to lose. As your investments grow and your financial situation changes, it's a good habit to periodically review your portfolio. This doesn't mean daily checks, but perhaps once or twice a year. Assess if your investments still align with your goals, risk tolerance, and time horizon. Robo-advisors often handle this automatically, but for self-directed investors, it's an important check-in. For our viewers who might be starting their investment journey a little later in life, perhaps over 50, don't despair. Congress understands that many Americans start late and has provided meaningful mechanisms to accelerate savings. In 2026, individuals over 50 can contribute an additional $7,500 to their 401k above the standard limit. These are called catch-up contributions and offer a powerful boost. Starting to invest, especially with little money, is not a race. It's a personal journey toward financial independence and achieving your life goals. Each small, consistent step you take contributes to that larger picture. Embrace the process, celebrate your progress, and remember that every dollar invested today is a seed planted for your future. Let's quickly recap your action plan for starting to invest with little money in 2026. First, define your why and set clear goals. Second, build that essential emergency fund and create a budget. Third, prioritize your employer's 401k match. Fourth, choose simple, diversified investments like broad market index funds or ETFs via fractional shares or robo-advisors. Finally, automate your contributions and stay consistent. Remember, the biggest hurdle is often just starting. Don't be intimidated by the financial jargon or the perceived complexity. With the tools available in 2026, and a clear understanding of your goals, investing with little money is not just possible, it's a smart and empowering move. Take that first step today, and watch your financial future begin to grow.